Well, I'm Joginder Rana. Topic of the day is understanding reinsurance ratio. Understanding reinsurance ratio. The insurance industry is a complex business with a wide range of risks involved in it. One of the significant challenges faced by insurance companies is to manage the risk exposure to their clients. So, reinsurance is a mechanism that helps insurance companies to reduce their exposure to risk by transferring portion of it to another insurance company. Understanding the concept of reinsurance ratio is essential for insurance companies to make informed decisions on risk management. So it is important to understand what is reinsurance ratio and how it can help strengthen coverage risk management. A reinsurance ratio is the percentage of risk that an insurance company transfers to a reinsurer. It is calculated by dividing the total amount of risk transferred to the reinsurer by the total amount of risk retained by the insurance company. For example, if an insurance company transfers $10 million of risk to a reinsurer and retains $20 million of risk, so the reinsurance ratio would be 33.3%, that is 10 upon 30. The reinsurance ratio is an essential tool in risk management for insurance companies. By transferring a portion of risk to a reinsurer, insurance companies can reduce their exposure to risk and protect their financial stability. So a higher reinsurance ratio indicates that an insurance company is transferring more risk to a reinsurer, which can strengthen their financial position in the event of a catastrophic loss. On the other hand, a lower reinsurance ratio means that an insurance company is retaining more risk, which can increase their exposure to financial losses. So, several factors can influence the reinsurance ratio of an insurance company. These include the type of insurance product, the geographical location of the insured, and the financial stability of the reinsurer. For example, insurance companies that provide coverage for high-risk products, such as earthquakes or hurricanes, may have a higher reinsurance ratio than those that provide coverage for low-risk products, such as life insurance. Similarly, insurance companies that operate in areas with high exposure to natural disasters may have a higher reinsurance ratio than those that operate in the areas with low exposure. So there are several options available for insurance companies to transfer risk to a reinsurer. These include facultative reinsurance, treaty reinsurance, and excess of loss reinsurance. Facultative reinsurance is a type of reinsurance where each risk is individually negotiated between the insurance company and the reinsurer. Treaty reinsurance is a type of reinsurance where the reinsurer agrees to cover all risks within a certain category, such as all automobile insurance policies. Excess of loss reinsurance is a type of reinsurance where the reinsurer agrees to cover losses above a certain threshold. So the best option for reinsurance depends on the specific needs of the insurance company. Facultative reinsurance may be the best option for insurance companies that have a low volume of high value risk, while TT reinsurance may be the best option for insurance companies that have a high volume of low value risk. So excess of loss reinsurance may be the best option for insurance companies that want to protect themselves against catastrophic losses. It is essential for insurance companies to evaluate their risk exposure and choose the reinsurance option that best suits their needs. So understanding the concept of reinsurance ratio is a crucial for insurance companies to make informed decisions on risk management. A higher reinsurance ratio can strengthen the financial position of an insurance company in the event of a catastrophic loss, while a lower reinsurance ratio can increase their exposure to financial losses. So several factors can influence the reinsurance ratio of an insurance company, and there are several options available for insurance companies to transfer risk to a reinsurer. Choosing the best option for insurance depends on the specific needs of the insurance company. So the importance of reinsurance ratio and coverage risk management cannot be ignored. When it comes to insurance, risk management is crucial to ensure that businesses don't face financial ruin. Reinsurance is one of the tools available to insurers to help manage risk. Reinsurance is a process whereby an insurer transfers a portion of its risk to another insurer. So the amount of risk transferred is known as the reinsurance ratio. The reinsurance ratio is a critical factor in coverage risk management, and let us see the importance of it. The basics of reinsurance ratio says the reinsurance ratio is the percentage of insurer's risk that is transferred to a reinsurance company. It is calculated by dividing the amount of risk transferred to the insurance company by the total amount of risk covered by the insurer. For example, if an insurer has covered 10 million in risk and transferred $5 million to a reinsurance company, the reinsurance ratio would be 50%. Now, the reinsurance ratio is an essential factor in coverage risk management for several reasons. Firstly, it helps insurers manage their exposure to risk by transferring a portion of the risk to a reinsurance company. So, insurers can reduce their exposure to catastrophic losses. Secondly, it helps insurers maintain their financial stability. And by transferring risk to a reinsurance company, insurers can ensure that they have sufficient funds to pay claims in the event of a catastrophic loss. Finally, the reinsurance ratio helps the insurers maintain their credit rating. So, insurers with high reinsurance ratios are seen as less likely or less risky by credit rating agencies, which can help them secure better rates on loans and other financial products. Now, insurers have several options when it comes to reinsurance ratios. They can choose to transfer a fixed percentage of their risk to a reinsurance company, or they can choose to transfer a specific dollar amount. They can also choose to transfer a portion of the risk to multiple reinsurance companies to spread their risk. The best option for an insurer will depend on their specific needs and risk profile. So, reinsurance ratios can vary widely depending on the insurer and the risk profile. For example, property and casualty insurer may have a reinsurance ratio of 50% to protect against catastrophic losses. So, while a life insurer may have a reinsurance ratio of 5% to protect against mortality risk. Additionally, the reinsurance ratio can change over time as the insurer's risk profile changes. So, the reinsurance ratio is a critical factor in coverage risk management. It helps insurers manage their exposure to risk, maintain their financial stability, and maintain their credit rating. The insurers have several options when it comes to reinsurance ratios, and the best option will depend on their specific needs and risk profile. So by understanding the importance of reinsurance ratios, insurers can better manage their risk and protect themselves from catastrophic losses. So how to calculate reinsurance ratio when it comes to managing risk? In the insurance industry, reinsurance is an essential tool that helps insurers spread their risk and reduce the potential by catastrophic losses. However, calculating the reinsurance ratio can be a complex task that requires a deep understanding of the insurance industry and the various factors that influence risk. Let us see how to calculate the reinsurance ratio and provide insights from different points of view. Reinsurance ratio is a measure of the amount of risk that an insurer transfers to the insurer. So it is calculated by dividing the amount of insurance purchased by the insurer by the total amount of the insurance written by the insurer. For example, if an insurer writes $100 million in premium and purchases $20 million in reinsurance, so the reinsurance ratio would be 20%. Now, several factors can influence the reinsurance ratio, including type of insurance being written, the insured's risk appetite, and the availability and cost of reinsurance. For example, insurers that write high-risk policies, such as earthquake or hurricane insurance, may have a higher reinsurance ratio to protect against catastrophic losses. So, a high reinsurance ratio can provide several benefits to insurers, including increased capacity to write policies, reduced exposure to catastrophic losses, and improved financial stability. However, a high reinsurance ratio can also increase the cost of insurance for policyholders and reduce the insurer's profitability. On the other hand, a low reinsurance ratio can increase the insurer's exposure to catastrophic losses and limit its ability to write policies in high-risk areas. It can also reduce the insurer's financial stability and increase the likelihood of insolvency in the event of a major loss. So, finding the optimal reinsurance ratio requires careful consideration of the insurer's risk appetite, the type of insurance being written, and the availability and cost of reinsurance. So, insurers should also consider a potential impact on policyholders and the insurer's financial stability. In general, a moderate reinsurance ratio that balances risk transfer and affordability is often the most effective approach. So, calculating the reinsurance ratio is an essential aspect of risk management for insurers. Now, by understanding the factors that influence the ratio and finding the optimal balance between the risk transfer and affordability, insurers can improve their financial stability, reduce exposures to catastrophic losses, and provide better protection for policyholders. So, reinsurance ratio is an essential tool to manage risk in the insurance industry. It represents the amount of insurance risk that an insurer passes to the insurer. However, several factors can affect the reinsurance ratio, and it is important to understand them to make informed decisions. The first one is exposures to catastrophic losses. Natural disasters and catastrophic events can cause significant losses to insurers. So, to mitigate the risk, insurers may opt to increase their reinsurance coverage. In such cases, the reinsurance ratio may increase, indicating that the insurer is transferring more risk to the reinsurer. For example, after Hurricane Katrina in 2005, many insurers increased their reinsurance ratios to cover potential losses from future hurricanes. So the cost of reinsurance increased, resulting in higher premiums for policyholders. Secondly, underwriting strategy. The underwriting strategy of an insurer can also affect the reinsurance ratio. If an insurer focuses on high-risk policies, it may need more reinsurance coverage to manage potential losses. On the other hand, if an insurer focuses on low-risk policies, it may require less reinsurance coverage. For instance, if an insurer specializes in insuring high-value properties, it may need more reinsurance coverage to manage the potential losses from fire or other damages. Then financial strength of insurers. The financial strength of an insurer is an important factor in determining the reinsurance ratio. A financially strong insurer may need less reinsurance coverage as it can absorb potential losses from its own resources. On the other hand, a financially weak insurer may need more reinsurance coverage to manage potential losses. For example, if an insurer has a high credit rating and strong financial reserves, it may require less reinsurance coverage to manage potential losses. And then regulatory requirements. Regulatory requirements can also affect the reinsurance ratio. Some jurisdictions may require insurers to maintain a specific reinsurance ratio to ensure they can manage potential losses. In such cases, insurers may need to increase their reinsurance coverage to comply with regulatory requirements. For instance, in some jurisdictions, insurers may be required to maintain a reinsurance ratio of 50%, indicating that they must transfer at least 50% of the risk to a reinsurer. And the last one is market conditions. The market conditions can also impact the reinsurance ratio. As the cost of reinsurance increases, insurers may need to increase their reinsurance coverage to manage potential losses. Conversely, if the cost of reinsurance decreases, insurers may reduce their reinsurance coverage. For example, if the cost of reinsurance decreases due to increased competition among reinsurers, insurers may reduce their reinsurance coverage to reduce cost. So several factors can affect the reinsurance ratio, including exposures to catastrophic losses, underwriting strategy, financial strength of the insurer, regulatory requirement, and market conditions. It is important for insurers to consider these factors when determining their reinsurance coverage to manage potential losses effectively. So reinsurance is a vital component in the insurance industry, and it is a way for insurance companies to manage their risk exposures. Reinsurance refers to the process of an insurance company transferring a portion of their risk to another insurance company. There are several types of reinsurance, and each type serves a specific purpose. Say, facultative reinsurance. This facultative reinsurance is a type of reinsurance that it is used to cover a single risk or a specific policy. So this type of reinsurance is used when the insurer wants to transfer a portion of the risk associated with a specific policy. Facultative reinsurance is typically used for high-risk policies or policies that are outside the insurer's normal risk appetite. For example, if an insurance company has a policy that exceeds the risk appetite, they may seek facultative reinsurance to cover that policy. Then TT insurance. TT reinsurance is a type of reinsurance that covers a group of policies. So this type of reinsurance is used when the insurer wants to transfer a portion of risk associated with a group of policies. TT reinsurance is typically used for policies that are within the insurer's normal risk appetite. For example, if an insurance company has a group of policies that are within the risk appetite, they may seek TT reinsurance to cover those policies. And the next one is proportional reinsurance. Proportional reinsurance is a type of reinsurance where the insurer and the reinsurer share the risk and the premium. This type of reinsurance is used when the insurer wants to transfer a portion of the risk associated with a policy, but it still wants to retain some of the risk. Non-proportional reinsurance is a type of reinsurance where the reinsurer takes on a specific amount of risk. This type of reinsurance is used when the insurer wants to transfer a portion of the risk associated with the policy but does not want to retain any of the risk. So there are several types of reinsurance, and each type serves a specific purpose. Proportional reinsurance is used when the insurer wants to transfer a portion of the risk and associated with the policy, but it still wants to retain some of the risk. Non-proportional reinsurance is used when the insurer wants to transfer a portion of the risk and associated with the policy, but does not want to retain any of the risk. Finally, excess of loss reinsurance is a type of non-proportional reinsurance where the reinsurer only pays out when the losses exceeds a specific amount of it. Thank you. Thank you very much.